Hey, I'm Jaden. On this channel, I break down the mechanics behind big market moves, options, volatility, the stuff most people skip over. No hype, just data. Today we're digging into the SpaceX IPO, $135 offering, $225 peak in 3 days, and an options market that crushed everyone who bought calls. Let's get into it. On the 12th of June, 2026, SpaceX priced its IPO at $135 a share, the largest initial public offering in history, $75 billion. 4 days later, the stock hit $225. And then, quietly, the options market did what it always does to new listings. It crushed implied volatility from 120% down to 86%, and traders who bought the right direction still lost money. SpaceX is the most anticipated IPO in a generation. Elon Musk's rocket company, operator of Starlink, the largest satellite constellation ever built, with active contracts for Mars missions and Department of Defense launches. The backers read like a who of global capital, KKR, the Kuwait Investment Authority, Nevada Idia through their Helix digital infrastructure announcement that same week. The IPO priced at $135. But here's the thing about a company this anticipated. The IPO price is not the price anyone actually pays on the open market. On the 12th of June, SPCX opened at 150. It hit a high of 176.52. It closed at $160.95. Volume was 540 million shares. For context, that is more first-day volume than most stocks see in a year. Now look at the price action day by day. The 12th of June, the IPO day, open at 150, close at 160, already up 19% from the offering price. The 15th of June, the following Monday, opens at 172 and closes at 192.50. That is another 20% move in a single session. Then the 16th of June, this is the peak. SPCX opens above 200, hits 225.64 intraday, then pulls back to close at 201.80. That high of 225 represents a 67% gain from the IPO price in just 3 trading days. And then the reversal, the 17th of June, the stock opens at 209, but trades down to a low of 187 and closes at 191. The 18th of June, another leg down, low of 172, close at 185. As of the 19th, SPCX sits around 181, still above the IPO price, but 30% below the peak. Options on SPCX became available shortly after the IPO, but here is something most traders did not expect. The chains were extremely thin at first. Only 2 expiration dates, the 18th of June and the 18th of September. Strike spacing was wide. Liquidity was limited. When we first checked the options chain on the 16th of June, the day of the peak, the at the money, implied volatility on the 17th of July calls was sitting at roughly 120%. To put that in perspective, the S&P 500 typically trades at about 15% IV. The market was pricing SpaceX at 8 times the normal uncertainty of the entire index. Okay, let me explain what that number actually means, because this is where people get tripped up. Implied volatility is not a prediction of direction. It is the price of uncertainty. When IV is 120%, the market is saying, we have no idea where this stock is going, but we think it could move a lot in either direction. And that uncertainty gets baked into the price of every single option. So when you buy a call at 120% IV, you are paying a massive premium just for the right to be in the game. And the moment that uncertainty starts to resolve in either direction, that premium starts to evaporate. That is IV crush. Now, look at what the options chain was telling us about where institutional money expected the stock to land. The largest open interest concentration on the call side was the 235 strike, 37,000 contracts. That is not retail. That is likely institutional hedging that marks their ceiling for the stock. Below that, call walls at 220 and 250, with another cluster at 200. On the put side, the biggest support was at 150, over 15,000 contracts, with secondary floors at 135 and 130. Notice that 135, that is the IPO price. Institutions were essentially saying, we do not think it goes below the offering. The gamma exposure analysis told the same story, above 2015. Positive gamma, meaning market maker hedging, would pin the price, dampen moves. Below 200, negative gamma, meaning moves would accelerate, and that is exactly what we saw. The stock peaked at 225, struggled in positive gamma territory, then fell through 200 into negative gamma and sold off hard. Here is where the real story is. Look at this dual chart. The top panel shows the stock price. The bottom shows implied volatility on the 17th of July at the money calls. The 16th of June, the peak day, I evolve at 120%. The 17th of June, one day later, Vol drops to about 101%. That is a 19-point drop in a single session. The 19th of June, IV is down to 86%. 34 points of implied volatility crushed in 4 trading days. And this is the critical thing to understand. This is not unusual for a new IPO. This is what always happens. The first few days of trading carry enormous uncertainty. As the market accumulates price data and the chains mature, that uncertainty resolves, IV compresses, and option buyers pay the price. Let me show you the trap. Say you bought at the 17th of July $210 call on the 16th of June. The stock was at 201. IV was 120%, and that call might have cost you around $20 per second hair, $2,000 per contract. Now fast forward to the 19th of June. The stock is at 181. Your call is deep out of the money and nearly worthless. But here is the worst scenario. Even if the stock had stayed flat at 201, your call would still have lost significant value at 86% IV. That same 210 call with the same time to expiry is worth roughly $14. You lost $6 a share, 30% of your investment. With the stock exactly where you bought it, that is pure IV crush. And if the stock had rallied from 201 to 210, putting your call exactly at the money, you still might have barely broken even, because the IV collapse would have eaten most of your directional gains. The house won either way. This is the thing about new IPOs. Everyone sees the stock moving 20-30% in a day and thinks, I need to buy calls. The FOMO is overwhelming, but the options market has already priced that excitement in. 120% IV means the market makers have already accounted for those massive moves. You are not getting a deal. You are paying full retail for lottery tickets at a markup. In a new IPO, the options market is the house, and on IV, the house always wins. So what is the takeaway? 3 things. First, in the early days of any IPO, the edge belongs to premium sellers, not buyers. If you have the capital and the risk tolerance, selling puts or covered calls in those first few sessions captures the IV decay that is almost guaranteed to happen. Second, if you want to buy options on a new listing, wait. Let the chains mature. Let IV settle to a baseline. Buying calls at 86%. IV is still expensive, but it is a fundamentally different trade than buying at 120. Third, if you are bullish on a new IPO and you want leveraged exposure, consider just buying shares. No IV risk, no time decay. You capture every dollar of upside without paying the uncertainty premium. SpaceX is a remarkable company, and the stock may well go higher from here. But the first week of SpaceX is a remarkable company, and the stock may well go higher from here. But the first week of options trading on any IPO is not a fair game. The math is stacked against the buyer from day one. Understanding that, knowing when the house has the edge and when you do. That is what this channel is about. Thanks for watching.